Right. Well, thanks a lot for the kind intro. Great to be back at Future PropTech. Maybe we'll wait a second till everyone takes a seat. Maybe while we wait, can I see a quick show of hands who's an entrepreneur? Okay, couple. And who's thinking about starting an instant home buyer model in the next 12 months? An instant home buyer model. Well, most people don't even know what it is. Okay, so maybe, hopefully, both of those things will change after this presentation. So, before we go straight in, a quick word about Loric Ventures. We are a pan-European PropTech fund with 3 colleagues. My partner, my colleague Tobias, is currently speaking about space as a service. And my third partner, Alex, is based out of Germany. We've invested in a bunch of PropTechs over the last couple of years, 3 of which are iBuyers or instant home buyers, which I'll talk about today. So I think this is probably one of the reasons I've been asked to speak about this topic. Quick word on the agenda. We'll speak about iBuyers in general and what they are. Actually, who doesn't know what an iBuyer is or an instant home buyer? Okay, good, excellent. So we'll speak a little about what they are and how they evolved over time. We'll speak about Opendoor, which is probably the most prominent instant home buyer business out there. We'll speak about the different models, a VC perspective on those specific models, success factors, and a bit about what the future of home selling could look like before, I think we have a couple of minutes to speak about Q&A. So the instant home buyer model, or short iBuyer, is actually a pretty old concept. And it, in essence, allows a property owner to sell their homes for cash, for an agreed price, instantly. So they don't have to wait months and months to find a buyer, but they'll know for sure they'll get an agreed price. In the past, this was actually, it came at a significant discount to what is the fair market value of a property. So it was only attractive for a very small niche of home sellers that were distressed or that went through a divorce or really needed the cash fast and were happy to take a discount. Now with the evolution of the home buyers for the last couple of years, really 2 things changed. So one, it's become an online proposition, where before those instant home buyers were offline. And 2, the prices paid for the homes were not at a discount anymore, but at fair market value. So the customer proposition has actually significantly improved. Saves a lot of time, saves hassle, in many cases, avoids taking out a second mortgage when you try to buy another property. And really, what the instant home buyer model does, it gives a lot of peace of mind when you probably engage in what's for most people the biggest financial transactions of their lives. So they know for a fact, on a click of a button, I will have that amount of cash in my bank account. And so this has evolved the last couple of years, and it's actually not just in real estate. You've seen it possibly also in other industries. For example, some of you might have heard of AutoOne, which does the same concept, but for cars. So if you want to sell a car, within 5 minutes, you know what price you're going to get, and you can sell it online. And AutoOne started roughly the same time as most of the iBuyers, and is now a multi-billion-dollar business just for cars in Europe alone. Opendoor is probably the most prominent of those iBuyers. Started 2015, first to market, is now selling roughly 1,000 properties a month, buying actually 1,000 properties a month. Raised $1 billion in equity, $2 billion in debt, and is quite widely viewed as the most successful of those models. And so what does Opendoor actually do? They buy the property from the seller, they refurbish those properties, and then they sell them on after, on average, 90 days. And so how do they make money? Well, they take a classic estate agent fee ranging from 6 to 13%, but they also make money through the value appreciation that they'll get through the refurbishment, so the difference between the price they pay and the price they then get by selling the property. And a lot of people think that Opendoor has the potential to become a really $100 billion business. And that's based on probably the fact that the residential real estate market is really ripe for disruption, and they've been viewed widely as a true disruptor. And that market alone is, in the US, for example, is massive when you look at the estate agent fees of over $2 trillion. And so, Opendoor is widely viewed as one of the few true disruptors in that space, and a lot of people see a lot of potential for this company. There's a couple of different models I quickly want to touch upon. First is what I just described with Opendoor. So buy, refurb, resell needs a lot of capital because you need to finance those acquisitions. And we'll talk about that in a second, but so very capital intensive. The second model, which is here featured by two European companies, Immo and Coded, is more kind of a source broker type model that needs a lot less capital. So effectively what those companies do is they still buy the property from home sellers, but they don't do that on their own balance sheet, but actually do that for third-party investors. And the focus here is more the management of those properties. So they will rent them out short-term, long-term, or whatever form, but they don't need to kind of flip them after a very short period of time. So very, very capital efficient way of this model. And the third is a UK-specific version of this model featured here by Nested, which some of you will know, which is the advanced model, let's call it like that, effectively acting more as a traditional broker where you won't see a title exchange, but what Nested does is it allows the chain-free transaction where if you want to buy a property while still owning one, you can use that advance that Nested gives you to go to the bank and effectively get a second mortgage without having to sell that first property or having to wait till you have actually sold that. So quite a nice way of, by the way, also allowing sellers to participate on the upside, because that's what Opendoor does when they flip. What Nested does when they effectively sell the property for more than they've given the advance for. They will share that upside with the sellers. VCs love iBuyers. So you might think we'll get into more detail about this. But why is it such a prominent estate agent or online estate agent model for the last couple of years? Well, the first reason is because the revenue per transaction is a lot higher vis-a-vis other online players. Most of you here in the room, I assume, will know Purple Bricks, which charges home sellers, flat fee of, I think, £1,000 to £2,000. Just to give you an idea, Opendoor, by charging, 6%, is roughly making, or 6 to 30% is roughly making $30,000 per transaction. So that is a lot more vis-a-vis kind of the flat fee online estate agent models. Also because they offer a great customer proposition, and so that allows them to charge in line with the high street agent. The other reason why VCs love iBuyer models, obviously, it's a huge market, ripe for disruption. I mean, I mentioned the estate agent fees. People are stressed about selling their homes, so someone needs to come and offer a customer-friendly proposition. And really, it's that success story of Opendoor, which is 6 years old, and last valuation was around close to $4 billion. So that success story has inspired similar models across the globe. So sounds all good. A lot of money going into the space. Sounds fairly easy, but actually it's not. And that's the second part of, I guess, this presentation I want to elaborate a little bit upon, which is this model is really, really complex. And there's a lot of ways you can mess this up if you run one of those kind of iBuyer businesses. The first kind of success factor I quickly want to speak about is obviously the price predictability, particularly for those companies that buy on their own balance sheet, refurb, and then resell. And so pricing that first transaction right is absolutely crucial, so you don't lose money in case you sell obviously for less than you bought for. So you need to factor in market downturns. You need to factor in, what the liquidity is for that particular type of property. And so, really, a lot of those iBuyers worldwide have built their own automated valuation models. to be able to really price right and often anticipate what they'll think they'll be able to sell the property for. The second point, which most people might not know, revolves around liquidity and the selection of inventory. So these are two examples of selection criteria that both Opendoor put out there and nested. And in fact, I think only 5% or so of the properties that that those companies get approached with are being presented with an offer. And the reason why they're so stringent on those criteria is very simple, because they don't want to end up with a property on their books that they can't sell. So you'd be surprised on the fine print on how selective those companies are and what kind of properties they take on and which not. Third point is probably the one I hear most when I talk to other VCs about this iBuy model, is cost and access of capital. So the sensitivity you see here shows you how many $1 billion in credit an iBuyer needs depending on how many properties they buy a month. So in this case, if you buy 1,000 properties a month, you need up to $2.7 billion in debt just to finance those transactions, assuming 90% or so of those transactions are financed with debt. This is a huge, obviously it's a big amount of capital. And then on top of that, it's not just access to this type of debt, but it's also the cost that you pay for it. So we'll all know, obviously with increasing interest rates, that will be more expensive. And so this will have a real impact on the P&L of those iBuyers. And I've just listed a couple of those transaction costs that those companies occur. So obviously, whilst they make a lot of money per transaction, they'll also occur a lot of variable costs. One of which is cost of capital, which I think I've hidden here somewhere under holding cost. The other very big part of those variable costs are the buy-side commissions, a bit more relevant for the US, obviously where you split buy and sell side. Can be quite high here with, I think in that particular instance, of a property worth $250,000, it's $12,500 dollars. So now what Opendoor has started doing is they become more of a marketplace where they connect buyers and sellers, so they avoid that buy-side commission. But it's just to show you that those transaction costs can be very high, and it's a very thin line to actually making a loss per transaction. And yeah, not obviously that easy. The last point on the critical success factors evolves around customer satisfaction. I mean, as with everything in tech, if you want to scale a business, you need to have a customer proposition that a lot of people like and will refer you to, so to bring acquisition costs down. The challenge with this model is that you'll end up rejecting most of the properties people want you to sell. So it can create obviously a lot of word to mouth and a lot of bad press if you reject every single customer that comes to you. So dealing with how you reject a lot of those customers is super, super important. And yeah, something I know, for example, Nested has spent a lot of time improving on and explaining to the customer why they take certain properties and why they don't take other properties on to their books. So what's home selling going to look like in the future? Obviously, no one has a crystal ball, as far as I know. And so this is really just my best estimate for what we're going to see over the next 10, 20 years. And if I take a punt, I'd say I'd really differentiate between two types of real estate markets. One is the very homogeneous real estate market where every house looks the same way, and I know for a fact what price I'll get for it, and I know how much liquidity there is. And so, in fact, if you look at the cities Opendoor has launched in the US, they're all what you can call maybe tier 2 type cities, where literally certain areas all look kind of the same. And really in those kind of markets, you should be able to sell your house on the click of a button, and it should be like a commodity type transaction. You shouldn't wait for months and months, and you shouldn't have that transaction uncertainty. Where this model might not necessarily work in the future that well is for more heterogeneous type markets. Think of New York, for example, where In a block, you'll have a skyscraper. You have a free storage house with condos, 2-bed studios, and suddenly it's a lot more difficult to predict supply demand. It's a lot more difficult to get pricing right. And so probably you'll see more kind of data-driven estate agent models prevail that are really good at matching buyers and sellers. So again, I think that's how if I paint a picture in the future, that's how I'd probably do it. But maybe up for discussion. And on that note, I don't know, do you have a couple of minutes for Q&A, or did I talk too long? Yes, okay.
Thanks. You mentioned automated valuation models are a big element of iBuyer models. Mm-hmm. Do you think they're of a sufficient standard to properly value and predict each of these assets?
I think, yeah, great question. I think it really depends on how price transparent the individual market is. If you look at markets like the US, where you have obviously the MLS data, if you look at markets like the UK, where the classifieds are very accurately giving you an indication on what your price, what your property is worth, those AVM models are not really a differentiator. I think if you look at markets like Germany or other parts of Europe where there's a big price intransparency, those models can make a real difference. So again, I would really differentiate between the types of geographies on that.
Okay, final question, so we stick to time.
Yeah. If you could just say a couple of, let's say the highest services provided from, sellers or, estate agents and everything that are at risk to not disappear, but, lose lots of market share because of technology. Where do you see kind of danger coming? If you can mention a couple of them, in your opinion.
I mean, I think if you take the UK, the market share of online estate agents is super low. I think it's below 5%, and 3% is just purple bricks. So I think we're far away from seeing a true disruption of that high street estate agent, and a lot of money has gone into customer acquisition costs and brand building, and you don't really see that actually in terms of true market share gains. I do think if you really capture that customer need of delivering a service at a good price point, which takes away that that huge stress that comes along with selling a home, I think we'll see more of those kind of iBuyer models be really successful, particularly if you have the data to know how you price right. And now I think there will be more disruption, and which is why companies like Zillow are starting their own iBuying kind of program. So yeah, I don't know if that answers your questions, but I think we'll see more of a combination between online and offline type services to really solve all the customer needs. Yep. All right.
Yep.
Cool.
Brilliant.
Thanks, guys. Cheers.
Thank you, Ricardo.